Palantir has delivered absolutely insane returns for early investors, turning a small position into life-changing wealth. The bad news is that most of you probably missed that boat. Sorry about that. The good news is that I found 4 AI defense stocks trading under 15 that appear to have pretty similar DNA to Palantir in those early days. And the best part, analysts are projecting significant upside potential for all 4 of these stocks. Hey, I'm Steve Reitmeister. I spent over a decade as editor-in-chief of Zacks.com, and I'm currently a partner at WallStreetZen.com, where our team built the Zen rating system, a quant model that analyzes 115 different factors for every stock that points to outperformance. And if you're serious about finding the next big AI defense winner, you need to watch this video to the end. And if you're about finding the next wave players for Palantir before they explode, hit that like button now. Okay, we'll get to those tickers in a second, but first let me quickly explain what I mean by Palantir's DNA, because this is the framework I use to find these special stocks. When you study what led to Palantir's more than 2,600% gain the past few years, 2 clear traits stand out. 1, deep technology with high barriers to entry. Palantir didn't AI onto an existing product. They built Foundry and AIP from the ground up and made these platforms so embedded in their customers' operations that switching costs are enormous, and this is why they continue to grow year after year. Number 2, government and defense revenue with serious tailwinds. Palantir's government contracts gave them a revenue floor that let them invest and grow even when commercial adoption was slow. With a proposed $1.5 trillion defense budget on the table, companies with established government relationships are positioned to capture a wave of new spending. I look for companies with these 2 traits as well as an additional 3rd trait that I'll get to in a second, but we first have to talk about the elephant in the room. Why not simply invest in Palantir? Plain and simple, it's because it doesn't score that well according to our Zen ratings quant model. Remember that at WallStreetZen, we built this rating system to evaluate 115 different fundamental factors for every stock. This covers 7 key categories, including value, growth, momentum, financials, and distills it down into intuitive letter grades A through F. Palantir's overall rating is only a C, where its value grade is a lowly D. So yes, it's a great company enjoying tremendous earnings growth, but the stock is priced for perfection, which shows up loud and clear in Palantir's forward PE ratio of 100. Remember that figure, which brings me to the 3rd thing I screen for in these stocks, that being a compelling valuation compared to Palantir. With Palantir, the easy money has already been made, whereas these stocks I'm about to show you, they are all trading under 15 with concrete catalysts in place. Profitability inflections, major contract wins, expanding government pipelines, which could drive significant growth. All right, with the framework in place, it's time to move on to these 4 exciting stocks. Stock number 1 is Coda Octopus Group with a symbol of CODA. This is a 30-year-old defense technology company with over 70 patents, almost 0 debt, and a 66.5% gross profit margin. The company builds real-time 3D underwater imaging sonar. Their technology lets operators see underwater in 0 visibility conditions. They also have augmented reality displays for Navy divers. In fact, they just delivered 16 next-gen systems to the U.S. Navy for $3.7 million. I know that doesn't sound that much, but a company like this only doing $26.6 million in total revenue, well, that one Navy contract is already accounting for 14% of the business, and it's still just in the early innings of its growth. Here's where it gets really interesting. They've recently launched their NanoGen series, which is designed as the core perception sensor for AI-enabled autonomous underwater vehicles. That's a massive pivot towards the AI defense space. Defense engineering now makes up 46% of their core revenue. Now, on the commercial side, their sonar technology is used in offshore oil and gas drilling, wind farm construction, and salvage operations, giving them a favorable dual-use model. Revenue grew 30.7% year over year, and recently they acquired Precision Acoustics to expand their defense capabilities and accelerate growth even further. The UK subsidiary is also positioned to capture increased European defense spending. Okay, Coda carries an overall Zen rating of A, meaning it's a strong buy and ranks in the top 3% of all stocks we analyze. And thanks to solid margins and near non-existent debt, the balance sheet is pretty darn healthy. Thus, not surprisingly, their financials grade is a B because Coda ranks in the top 20% of stocks in this vital category. Wall Street analysts are forecasting earnings growth of nearly 29% per year going forward. That's good to know, as we appreciate that the forward PE is 25. That isn't expensive for that kind of growth, and it's a straight up steal compared to Palantir's 100 times forward PE. The company has delivered 4 impressive earnings beats in a row. The last one at the tail end of January, well, the share price has gone up by more than 20% since then, yet still has appealing valuation upside from here. Don't sleep on this one. Coda shares are seeing plenty of momentum right now, and you don't want to miss the boat. Now, I don't want to downplay the risk either. This is a microcap stock where the entire business is valued at just $146 million. This also means shares can be sometimes illiquid and quite volatile. The company needs to prove it can scale up from here, and like any defense contractor, it's dependent on government spending, so any budget cuts would hurt their outlook. But the core thesis remains solid. A company with 70-plus patents, solid growth expectations, no debt, which is set to benefit from accelerating defense revenue, not just in the U.S., but internationally. All of that, plus is trading at a fraction of what most defense tech names go for. I think the risk-reward here is quite compelling. By the way, if you're finding value in this kind of deep dive research in stocks most channels will never cover, then please subscribe and hit the notification bell. That's because I publish top stock picks regularly, and you don't want to miss the next one of these videos. Okay, next up is our second stock, which is UiPath with a symbol of PATH. The stock once traded at $85 per share, and yet now is down all the way under $15. This is the number one ranked agentic automation platform in the world. They build software robots that automate repetitive enterprise tasks like invoice processing, compliance workflows, and data entry. Over 950 companies are now building AI agents on UiPath's platform. Their partner list looks like a who in tech: Microsoft, Alphabet, Amazon, SAP, NVIDIA, OpenAI, and more. Now, here's the defense angle. UiPath is already embedded in major government agencies. Its automation powers claims processing at the Veterans Administration, and it's deepening deployments with the U.S. Coast Guard and Social Security Administration. Management has called the public sector a substantial opportunity. Not to mention, the company was just added to the S&P Midcap 400 in January because of its growth to date. UiPath just reported its first profitable quarter in company history and is on track for its full year profitability in fiscal 2026. Now, that's exactly where Palantir was 2-3 years ago, right at that vital profitability inflection point. Last quarter revenue hit $411 million, up 16% year over year. This is in large part thanks to annual recurring revenue growing 11%, where net dollar retention at 107%, which means their current contracts are proven to be very sticky. At a forward PE just a hair above 15, this is incredibly cheap for an AI platform company experiencing this kind of growth. UiPath has a Zen rating of B, which means it's a buy recommendation. Even better is that our quant system puts it in the top 6% of all stocks when it comes to wide-ranging fundamental review. Path also ranks in the top 10% of all stocks for growth and financials. These are the most important elements that point to greater likelihood of earnings beats in the quarters ahead. Now, the average Wall Street analyst has a price target on these shares that points to 45% upside potential. Even better, the street high price target implies 70% upside. That's strong conviction from Wall Street. The risks are real, though. This is not a pure defense play. Government contracts are growing, but not yet the dominant source of revenue. There's also fierce competition from the likes of Microsoft, ServiceNow, and Salesforce in the automation space. The fact that it's down over 80% from its peak could also reflect structural concerns the market has priced in. Now, I'm not saying it's going back to its pandemic high anytime soon, but even a repricing to just 30 to 40 times earnings as the agentic AI story plays out would represent significant upside from current levels and quite deserving given their growth potential. This next pick is sitting on a jaw-dropping contract for a company its size. I'm talking about Telos Corporation, TLS, trading in the $5 range. Telos was recently selected for the Missile Defense Agency SHIELD contract with a ceiling value of $151 billion. Yes, billion with a B. That's mighty impressive for a company with only a $320 million market cap. Now, Telos builds cybersecurity, cloud security, and identity solutions for the Department of Defense, the intelligence community, and federal agencies. Their flagship product, Xacta, is an AI-powered cyber governance and compliance platform that holds FedRAMP's highest authorization. They just launched Xacta.ai, which reduces compliance timelines from months to days. They claim a roughly 90% efficiency gain on that system. They also run TSA's pre-check enrollment at over 500 locations across across the U.S., which provides a massive recurring revenue stream. This company has been in the government technology space since 1968, so we're dealing with even deeper roots here than Palantir. The turnaround story here is compelling as Q3 2025 was truly a breakout quarter. Revenue hit $51.4 million, up 116% year over year, driven overwhelmingly by their security solutions segment. They also posted their strongest EBITDA margin in the years at 19.6%. Plus, management says they're sitting on a $5 billion pipeline of new business opportunities. The data lines up. Telos earns an overall Zen rating of B, which is a clear buy signal, but the growth component is what really stands out. It grades as an A in the 99th percentile, putting Telos in the top 1% of all stocks for this favorable growth category. The Wall Street analyst community is getting on board too. The average price target for the stock implies upside potential of more than 100%, whereas the max forecast points to 125% upside potential. But it's not all rainbows and lollipops. Telos is still unprofitable on a trailing basis. They lost $29.6 million over the last 12 months, and the stock is down about 34% from its 3-month high, so volatility here is very real. But if this revenue growth trajectory continues, and the analyst target prices suggest it will, a company with this large of a government pipeline is hard to ignore. Before I get to the last stock, let me share something special. I created a free report with 3 stocks I believe could double or more in the coming year. Hit the link in the description or scan the QR code to get it now. Okay, the last stock on my list just landed a brand new European defense contract that has analysts abuzz about future growth prospects. I'm talking about Gilat Satellite Networks with the symbol of GILT. This company builds satellite-based broadband communication systems for both defense and commercial applications. Their defense division manufactures SATCOM terminals that are used by forward-deployed military forces, and through their subsidiary DataPath, they make transportable terminals for the U.S. Department of Defense. Now, this is not just a U.S.-based story. The company has recently secured multi-million-dollar contracts from Israel's Ministry of Defense, helping to make 2025 a record year for its defense division. Gilat has also launched a new Earth observation capability for defense customers, and they're expanding aggressively into European sovereign defense programs as U.S. nations ramp up their military spending. Gladly, they also have commercial applications for their products. This is part of their dual-use Palantir DNA. In particular, Gilat is a strong player for in-flight connectivity. Through their Stellar Blue subsidiary, roughly 225 aircraft are already flying with Gilat antennas that helps generate $127 million in revenue in 2025, and that is expected to increase as we go forward. The company supports multi-orbit satellite constellations, LEO, MEO, and GEO, position them squarely in the new space economy. The financial momentum is outstanding. Full year 2025 revenue came in at $451.7 million. That's 48% growth year over year. Looking ahead, management is guiding for even more growth in 2026, between $520 million. They're sitting on $183 million in net cash, and their order backlog exceeds $210 million, giving great visibility to their future growth. Helping swell that backlog are some recent contract wins like the $85 million upgrades for Peru's National Digital Inclusion Network, plus a $42 million Sky Edge 4 order. Okay. Gilat earns a Zen rating of B, which puts it firmly in the buy camp. It scores the best for momentum in the top 14% of all stocks we track. This reflects that some investors are already tuned into this unique growth story, but gladly, there's a great reason to believe there is even more upside ahead. Only one Wall Street analyst issues ratings for the stock. However, that one analyst happens to be in the top 1% of all Wall Street researchers in terms of actual stock picking performance. I'm talking about Ryan Coots from Needham, and his fair value price target implies about 50% upside for Gilat shares in the year to come. Here are the risks you need to know about. Gilat is based in Israel, which carries real geopolitical risk given ongoing regional tensions. Also, the stock just pulled back more than 20% in the past month. That kind of volatility comes with the territory after a stock nearly doubles in the past year. And profit margins are still running thin at about 4.6%, meaning revenue growth hasn't fully translated into bottom line profit yet. Even so, we have 48% revenue growth, a record defense year, expansion into European sovereign defense, and a hearty $210 million backlog. Yet for a stock trading under 15, the attractive setup here is hard to ignore. Now, I want to be upfront. Most of these are small caps and volatile sector, which means bigger price swings in both directions. Do your own due diligence and size your positions accordingly. Some of the best tools to track and analyze stocks like these are available for free at WallStreetZen.com. And now I want to hear from you. Which of these 4 stocks are you most interested in? Or maybe there are other AI defense names I missed. Drop your thoughts in the comments below. I read every single one of them. Lastly, if you want to find out my #1 tech stock for 2026, then check out the video that's popping up on your screen right now. That position is already up more than 70% in the last few months, yet even still, I rate it as one of my top stocks for the year ahead.